Hello and welcome to Core 4. I'm Coach Brandon Adams, and I'm here to bring you another week of our journey in Core 4. What's beautiful about Core 4 is that we look at four different attributes that will help you and me and everybody else associated with us get from where you are to where you want to be. And so that's mindset number one, replacing your 9 to 5. Investments, which would be active and passive, and then finally retirement. What vehicles are you using for your retirement? So our show is centered around helping you to understand really the economic climate, where money is made in alternative markets, and how we're doing in those. And so we don't really give out a lot of information unless you contact us privately to kind of ask us where we are in a particular project. So, for example, one of our projects is Kong, Kong. And so Kong is designed to basically be like an employee. It's a bot that is associated with the Forex market. And so the bot is doing a wonderful job. It's up 17%. It uses a certain type of a strategy for when it loses so that it can pick up and win. And it's been up over the past about 500 or so days, about, 1,200%. So if you had 12,000 in there, it's probably at like 186,000 now. It's just ridiculous. So how do you get involved in that? Just contact us, let us know. We also have Go Baby Trade, which is a Coinbase operating system basically. And so you basically attach your algorithm to Coinbase for Go Baby Trade, and it actually will manage and buy low and sell high on only the crypto that you find that's going to range the most, buying and selling high and low. So that's another wonderful attribute. We also, with Eric Majors, we also have a fantastic yield farming, and so he has a course that's $1,500 that you can actually purchase from him, and it's on discount for six normally. And so just contact us if you're interested. And so there's a passive side to it, but pretty much, there's active. And so if you're interested in learning how that works and getting transactional fees, a percentage of those fees based on the liquidity that you provide with different liquidity pairs. That's 100% on you and your decision. And so you have an opportunity to work with that. We also have the Core 4 bot, which is our internal bot. And that bot actually is doing a great job as well. It gets about 17% for the last, I think it's 4 years that it's been getting about 17%. So you're going to double your money every few years. And so that's just a safe, steady retirement. Just let it work and let it do its thing. And then we also have a couple of other ways that we create money. And so we have a team, and so you can contact me with that. We have case studies. We have, I'm using a smartwatch to be able to make money and generate from mining, and it's a proof of activity as opposed to a proof of stake or a proof of work. We also have a new cloud-based opportunity that we're excited about that actually mines the crypto within your home, and it's a server that's creating a neural network of other servers. And so one day we'll have someone come and talk about that if you're interested in it. And then we also have some private stuff that we do as well. And then we are blessed to have Chris Pulver and what he's doing. And so today we're going to talk a little bit about options and how he's able to, with Streamwise Capital, really generate some fascinating returns. And it's kind of and as I bring him on, maybe he'll correct me, but I would almost say that it's semi-active or semi-passive, and we'll talk about if I'm right about that and why. So without further ado, let's bring on one of my very good friends. What's up, buddy?
Hey, Brandon. Hey, everybody. Happy Sunday.
Happy Sunday, man. So let's just dive right in with Streamwise and what you're doing. Um, when somebody has an account, you actually will they have the account, but then you actually become like sort of a custodian of that account to be able to trade out of it for them. Is that kind of what happens?
In a way, I mean, I just have trading authority. So we complete the paperwork through the broker, and they give me access to the account to trade it. So it's fully transparent, where it's in the client's name, whether it's a IRA, family trust, corporate account, cash margin account, doesn't matter, whatever account you want. You open the account, and you grant me permission to trade it. So that's all it really entails.
Now, and that is that with options only, or do you do forex with that, or is it stocks? Is it a combination of things? What is it that you focus on?
It's a blend. I don't do forex with this particular one. I've migrated since I had my little hedge fund days, and I went over to just now individual managed accounts. I trade ETFs, stocks, options, futures options. I can trade crypto, which I do. So I actually trade a little bit of Bitcoin and some options around like the Bitcoin futures. Trade the spot ETFs like IBIT to have some exposure. I like that kind of 3 to 5% exposure in Bitcoin, just to have that as the little allocation to the overall portfolio. So I trade everything. I moved away from managing in forex, other than just a couple of non-US accounts that I'm working with that are just running with robots. So I have some forex investments. I have some robots running, but for the most part, my active portfolio is stocks, options, ETFs, futures options, things like that. So I mean, we're doing really well this year. We're actually, so the S&P is up about 19 and change right now. I'm at like 18 and a half, and my drawdown this year was less than 3%.
Really?
So I mean, we had a 10 to 15% pullback in mid-July into August. The average pullback for the S&P is around 13%. So I mean, we're staying there with gains. We've had virtually zero growth in Bitcoin in the portfolio, outside of, there's some appreciation here and there, but we're flat on the Bitcoin side of things. We had a big jump the last couple of weeks in China, which I've been exposed in China for the last year plus, kind of waiting for this move to happen. Now the fact that China jumped the way that it did, it's like mind blowing that we had an index like FXI, the HSI, some individual stocks like Alibaba, Baidu, JD.com. I mean, some of these stocks have ripped 30, 40, 50% in the last 2 weeks. It's they're trading like GameStop, they're trading like meme stocks. But the reality is there's a lot of volume behind these, and this is a benefit to actually having, like they're called ADRs, which is American Depository Receipt,
Yep.
and this is a Chinese company that can be traded in the U.S. exchange, and so that type of order flow and catch up. It's just, I think right now investors are looking for growth opportunities. I think they're looking for something that's going to generate some returns. We're certainly getting a little sideways, and I wouldn't say toppy necessarily. We're sideways as the market's lacking a major catalyst to drive it higher. We're coming up with election drama in the next 30 days or so, 30 to 35 days as we roll in November. We had a big jobs number last week. We have inflation data this week on Thursday. We have earnings season kicking off here prior to the election. So for the next 3-4 weeks, all the big companies reporting earnings. And, in a way, I think they're kind of priced to perfection. So I wouldn't be surprised to see pullbacks in the market. But pullbacks to me are buy on dips unless structure changes, which I don't see that happening. If we don't have a nasty inflation uptick, then I think the market's going to continue to, even ignore the election, unless it's super dramatic. But I think the market's going to ignore the election, find a way just to grind higher and melt up higher for the rest of the year. But that might last us into Q4, Q1, Q2 next year. And then the landscape looks at, how well are these stocks valued in the U.S. Is the U.S. growth kind of tapering off and rounding out? So there's a lot to navigate. But like I said, my portfolio, as far as diversification, we've had a lot of active income trading this year. We've generated some nice steady returns without having a bunch of exposure, but well diversified. The core positions I'm in, gold and silver, have been doing really well, and they've been steady. Obviously, gold's at all-time highs and actually outpacing the S&P this year. Bitcoin, some exposure. China, some exposure. China's taken off. Bitcoin's still waiting. Trading a lot of index stuff, generating income week to week. I have a lot of campaign trades that I place every week or every month, and it's very mechanical, very routine. So this has all been good stuff. And then, just a few positions here and there that I'm working and massaging and looking at some income plays. Like, there's a lot of stuff, man. I mean, I like when I look at my portfolio A to Z, it doesn't seem like it has to be like, oh, if the market's down, I'm down. It's really not the case. I mean, I've had days where the market drops 1, 2, 3%, and I have a new high in my portfolio.
Yeah.
I have days that the market is up and I'm flat. So I mean, I watch things here and there, but usually when the market's up, so is my portfolio. If the market's sideways, my portfolio is doing fine and generating income. We go down, I mitigate the risk pretty well where I'm hedged, and I really am. I mean, I'm hedged out to like November 15th, on the end of the year, just in case we do have some type of volatility event like we had early August. I don't think that's going to repeat, but I just don't want to be caught, blindsided by something with geopolitical tensions going higher. We have everything with Hezbollah and Israel right now in the Middle East. Oil prices are going all over the place. China unveiled and unleashed crazy amounts of stimulus. The Fed cut rates by 50 basis points. So all these things are out there that should churn the market higher. But Middle East tensions and oil prices and commodity prices can obviously lead to higher inflation. And that's right back on the Fed's shoulders of, is the Fed going to get it right? Are they going to navigate this soft landing? And nobody knows. I mean, the Fed could be totally right and get lucky and thread the needle, or the Fed can be totally wrong, and cutting 50 basis points is now seen like it was too much too quickly and the market's backpedaling. So I don't know. I think the market's going to try to find a way to go higher. At the end of the day, it doesn't matter. If you're a long-term investor, just buy. If you're a long-term investor, trade the instruments, buy the haystack, and give yourself 10, 15, 20 years, and you'll double your money probably every 7 to 8 years if you're fully invested. But that's not easy because there's sentiment, and there's emotions, and there's fear and greed, and that's why everybody is a terrible investor for the most part,
All
because
right.
there's way too much emotion in it.
So let's talk a little bit. Let's go back. So you said that you're about matched up with the S&P for the year.
Yep.
Is that right? Okay.
Yep.
And so people need to really understand that if you're in a regular Charles Schwab account, if you're in a UBS, you're not really at 19%, are you? You're probably
No.
somewhere 7, 8, 9% lower than that. Would you agree?
Most likely. I'm going to check here the Barclay Hedge Fund Index right now for the year. Let's go to Barclay Hedge Fund Index. I'm assuming it's underperforming. Right now, the Barclay Hedge Fund Index is up about 9% for the year. And it had a pullback in April. It hasn't posted anything through. Actually, surprisingly, it had a positive month in September because we had that Labor Day sell-off. But typically, here's how it works. If you're sitting with the Charles Schwab or you're sitting with a financial advisor, in fact, here's some just straight truth. Financial advisors are going to peddle their own instruments. So if you're with a Merrill Lynch advisor or a Schwab advisor or a Fisher advisor or whatever advisor, they like to put you in mutual funds that their firms have low fees on, but their low fees are also higher commissions to your financial advisor. So typically they don't want to diversify you. They don't want to go and just put you in. I mean, why can't they just make you invest in the S&P? Buy the SPY and pay 0.3%. Buy a Vanguard S&P fund and pay 0.3% instead of paying 1.5 to 2%. So that's the trade-off with financial advisors is a lot of them are personal relationships, and you might like the person and you might think they're doing they have your best interests at heart, but they don't. And usually they're going to underperform. And usually what's best for them is to keep you in instruments that's best for their firm, giving them job security and job stability, and also giving them assets under management, which people won't leave. That is the biggest thing I hear with financial advisors is as soon as you ask to leave or ask to be, changing things, it's like they are so much opposition where it's like, they don't want you to leave. They don't want you to question their process. So, and I've actually had this conversation with James. James had said he I think it's his parents actually. His parents were dealing with a financial advisor that said, we can't sell these positions. We can't sell these positions. And it's like, what are you talking about? This isn't a hedge fund with lockup periods. Like if these are mutual funds, they could be closed out end of day.
Exactly.
If these are, positions I don't want to be in, then close them out and move me into another bucket. And that's what they do is they operate in these like big buckets of let's put you in a growth bucket, put you in a, little cash, put you in some bonds, put you in this. And so when you're not fully invested, there's no way you're going to get the full returns of what the index is doing. So they typically always underperform the benchmarks. If you're lucky, you're going to take a little bit less risk in the event of a drawdown. 2022 is a good example. Some friends of mine that worked at Northwestern Mutual, their average drawdown was about 16 to 18% when the market was down 25 to 30%. So they might save you a little bit on the risk side, but they're going to underperform on the high side too. So instead of the market going up 20% like it is this year, their performance is typically going to be in the single digits, 8 to 10%.
So would you call that like more like retail. So when you're looking at the hedge funds, the UBSs, all the rest of the stuff, that's like retail. So you're not going to, if you think about it with clothes, if you go to Nordstrom's, you're going to pay a premium for being at Nordstrom's. Are you looking at the premium that you're actually paying is that you're not going to be making as much because you're really paying for the big name and your association with them. Is that correct?
I guess. I mean, what you're paying for is you're supposed to be paying for freaking performance,
Yeah.
and you're not. You're not getting it. I mean, I just listened. I think I just took a screenshot of this. I was just listening to a podcast. Let me see if I have it here. The hedge fund performance. Yeah, right here. So the total performance, this goes back the last 15 years. So 2009 to August 2024, which you'd think is a pretty good time to be an investor. Once we actually bottomed in 2009, the S&P, so the combination of like a very standard 60-40 portfolio, which would be 60% equities, 40% bonds, which I think is a trash portfolio, by the way. If I want to put 40% in something, I'm not going to put it in bonds. I don't care about bonds. I think the U.S. bond market at some point is going to break, and there's going to be a debt spiral that the U.S. can't even have, successful bond auctions at some point. So I'd rather be in gold. And historically, gold, if you put that as the 40 allocation, gold actually outperforms the typical 60-40. If you have 60 in stocks and 40 in gold, it outperforms the traditional 60-40. So just a little FYI. But anyway, 295% over that 15-year period if you had a balanced 60-40 portfolio.
Yep.
Pretty standard. If you were just fully invested in equities, you're going to have probably double or triple that easily. But you're going to take a lot, all the drawdowns we saw from 2015, 16, 2018, 2020, 2022, all those drawdowns, most investors panic when that happens, but you're going
Absolutely.
to have crazy more upside if you just were invested in equities. But the hedge fund index, so let's just round the 60-40 portfolio up to 300% over a 15-year period. Your hedge fund index was about 117. So you have basically it's 3 times less you're paying for performance, you're paying for the name, you're paying for this person to take care of you.
Yeah.
It performs to the tune of like 3 times worse. So, look, I know that you're talking about Streamwise Capital. The difference is, I mean, I'm fully transparent with all my clients. I actively generate income. So it's not just stay invested. Stay invested. It's like if I were to buy the SPY, I would be trading around my position every single week, every single month to 1, generate income on it, and 2, increase my gains, 3, lower my cost basis so I can own it and increase the net profit, as opposed to just buy and hold. So even something that simple is different. What's that?
So you try to target roughly up to about 4% a month. Like that's
Sure. I mean, 3% a month is great, right? That's 36% a year. I
yeah.
mean, look, the average S&P, I mean, we've had this baller run for a decade where we've had about 14 to 15% return on the S&P for the last decade. It's been like one of the most and the hottest bull markets we've ever had. Now, the average return is around 8%. You throw in dividends if you're fully invested and you collect those dividends, you're getting 8.5%, 9% annualized. Now, if you want to get roughly 8 or 9% a year, you got to take 13 to 20% drawdowns to get that. You got to stay fully invested through good times and bad times. People don't do that. People panic. People call their financial advisor. People want to know what the heck's going on. So all these things factor into it, which is why people as a whole are typically terrible investors.
Yeah.
So the financial advisor, here's what they do. They want you to be invested. And if their job is to keep you invested, it actually does have a benefit because they'll just keep you from sabotaging your own returns. But for a trader or investor that has some common sense and that can look and see what history has done performance wise, look, if the market's going to go higher and higher and higher, it's going to have some pullbacks and discounts. That's my favorite thing. Like when we had that dip in August, I was selling a bunch of premium and generating income and adding new positions. And I have, Brandon, I've got like $800,000 of cash to buy stuff.
Hmm.
So when I have an opportunity, I'm going to deploy cash, which typically is a good thing because I'm not fully invested at all. So I have lots of opportunity when I see something looks good, I can participate and be pretty aggressive. So even if I took like, a 10% allocation and I threw it at something in the short term, that could end up moving the needle for my fund 5%. So for me, my returns, I don't like to set monthly goals. I really don't because I work with the ebbs and flows of the market. Typically seasonality wise, we have a strong like November, December, January, February, March. those are usually some pretty good periods of bullishness. But everyone says sell and may go away. That's actually totally false. I mean, if you still bought and owned stocks from like end of May into October, it is only like a 1 to 2% difference historically from owning for 12 years, or I'm sorry, 12 months at a time.
So do me a favor, jump over on Tesla for a second.
Okay, sure.
So there was a time that Tesla was up around $800. Is that
Uh, yeah,
or
there would have been because there was splits back here. You had a 5-for-1 split. So based on this price around 150 bucks, you do 5 times that, you're looking at like $600 or $700 stock. Yeah.
so the deal is that does it get back up there again, or is that not the goal?
No, that's totally the goal. I mean, same thing on Apple. Apple has been, a 10, 20, 30, $50 stock, and then it gets into the hundreds, and the hundreds turns into high hundreds, and then Apple does like a 10-for-1 split, and then it becomes like a $50 to $100 stock again. Amazon was $1,000 stock, and it did a 10-for-1 split. Now it's $170, $180. Chipotle was a $2,000 stock, and it did like a 50-for-1 split. So now it's trading under $100. So it doesn't change the net asset value of the position, but those splits just provide more flow where all of a sudden it's not seen as expensive. So if Tesla's $1,000 stock, not very many allocations are going to it because, unless you're going to buy fractional shares, Tesla, not many people are. It's kind of pricing people out of $1,000 stock. That's a lot to allocate for one share. If you want to control any options around that, that's a big. I mean, to control a tranche of options, you need at least 100 shares. So,
Exactly.
I mean, that's a lot of money to be tied up in Tesla. It's like, well, if it's $1,000 stock, that's $100,000 position in cash just to say I can control one covered call on Tesla. So,
So
but it'll get it. I mean, that's the goal. It should get up there again.
it should get up there again,
Yeah.
and that's kind of what I'm trying to say, because all previous highs have been eclipsed at some point. So when we look at Nvidia,
Uh
let's
huh.
talk about that for a second. So
Okay.
Nvidia is like, the creme de la creme in terms of the AI chips and all the rest of that stuff, right?
Sure. For
And
right now.
so for right now,
Yep.
okay. So you look at it, it might be priced a little high for most people. So then you have Microsoft that's coming up with its own chip, correct?
They're all trying to. I mean, you've got Intel, you got Microsoft, you got yeah. I mean, a lot of them are doing partnerships with Nvidia right now. A lot of them are working with others. Like, I mean, there's some legacy stocks that have been doing pretty well. In the face of Nvidia just being a steamroller in the AI space and the chip space. I mean, Dell has had a good run, Oracle's had a good run, Intel's has been right there.
What about
But I mean, eventually you're going to have a Microsoft and a Google and an Apple and even a Tesla. Like they're going to start making their own chips. They're going to partner with other things to create competition. Where Nvidia is not going to be the only game in town. It's going to be broader. It's going to be more competition. It's going to drive prices lower, and that competition is good. That's capitalism.
so tell me about, have you heard of Cerebras? Is that
No.
so that's an IPO that's coming out. And
Okay.
I'm just putting it out there because I've been hearing a lot of buzz about it.
Hmm.
And so I just kind of wanted to put it on our radar. I mean, you and James do such a good job, but that's something that I want us to do a little research on.
Okay.
So when we look at the SPY, and when you because number one, I see where it had that dip, and then it kind of came back up, and we've been looking at it, and it's kind of just been in this little channel, right? It's been
Yeah, it's been super choppy for the last couple of weeks. We've had about 3 weeks of indecision. Post the Fed on September 18th, we haven't done anything for 3 weeks.
so, and we also see that it's right above its support, right? And
Yep.
so is this a time? Do you think that it breaks out of this and goes north, or do you think that it's going to touch some lows and then drive its way up? Like, what would your prediction be based on some fundamentals and some other stuff that you kind of put together?
Yeah, I mean, I'd love to see a dip just because I want there to be an opportunity to position for a discount or a lower low, or I guess just a pullback. If we go higher, 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 that's fine, but it's harder to participate at all-time highs when you feel like a correction and more of the risk is to the downside than it is the upside. I mean, look, Every major investment bank this year, Goldman Sachs, JP Morgan, Bank of America, Wells Fargo, all these analysts have predicted that the S&P 500 this year would end up at, see the number right here,
Yeah.
5750. This year, when the market started, the highest investment bank forecast for the S&P was 4,800.
Oh, it's beat everything.
I mean, they're way off, and all they did is they're like, oh, okay, we'll go 5,000. Oh, okay, we'll go 5,200. Oh, okay, we'll go 5,400. So all they keep doing is changing their forecast, which they don't have any ramifications being right or wrong. They can be dead wrong, and so if it goes higher, it's designed to go higher. The only issue that I have here is we are priced to perfection, in my opinion. So that means this earnings season, as we get into the election, and we've got 3-4 weeks of hard earnings with thousands of companies, if we don't see a consensus that is broadly positive, beating top and bottom estimates, so earnings per share and revenue is beat, forward guidance is positive and optimistic, everyone's looking forward to the rest of the year and looking into Q1, Q2 of next year into 2025 outlooks. If they're not super upbeat and super positive, I could see the market being just a little toppy here and then warranting a bit of a correction. But if you just look at these lines I have in my charts, this is a really simple industry standard 50, 100, 200 moving average. All I'm looking for here is there's nothing about this market structure that would tell me to be bearish. Nothing.
Yeah.
Okay. So even here, if we had a pullback all the way back down to this level, that's about a 9 to 10% pullback, Brandon, and that's not going to be fun. So do I think that's going to happen? No. But if it does start to roll over by 2 to 5%, 3 to 5%, I'm still looking to see, okay, well, can we just bounce off of a dynamic level to then offer the market on a discount or a dip? Now, the reality is too, like maybe we just go sideways and this line catches up and we like kind of bounce off that level, and then we have the seasonality, the election, like all the news is now being priced in and whatever. So the market has room to grow. I mean, just based on my chart here, there's room up here, man. There's room up to 600 plus on the SPY, which is 6,000 plus in the S&P. I think we can get there. Do we get there by the end of the year? Maybe. But if we don't, I mean, I wouldn't mind seeing a dip and a pullback that we can then buy a dip and then see it get up to 6,000 plus or 600 on the SPY. So I would personally like a pullback. But I think that the painful trade is you're not going to get much of a pullback because the Fed has already cut rates. They're probably still going to cut another 25 to 50 basis points. If inflation doesn't scare the market right now, job numbers have really rebounded in a nice way where we had the SOM rule, and this is basically it's an employment data point that triggered that our employment situation is trending the wrong direction. This was back in July of this year. Well, August was when we had the SOM rule activated. We had the Japanese yen deleveraging, and it got really scary there for a couple of days. And then what happened? Buy the dip, and we're back up to all-time highs in the same month. September did what it usually doesn't do. In fact, it broke a streak 10 times out of 10. When the market in September for the first week sold off and was in red, 10 out of 10 times for like 50 years, it finishes red for the month. Didn't happen this year. This year, the market actually finished back up at all-time highs with September. And look at these monthly charts. This is actually pretty wild. You can see this market is so aggressive at just buying dips right now. And at some point, it will stop, But for the month of September, look at this. We had one April of this year pullback. This was from November, December of last year, January, February, March. We had one pullback in April. May, June, July. Look at August rip to the upside, and then even September finishing all-time highs. This market doesn't care about anything outside of trying to get higher, trying to grind higher, and that's why I'm saying like the scary stuff is to the downside, but I think the scary stuff right now is still being purchased because the story is the Fed is cutting. It's no longer as restrictive. But there's a couple things I'm watching really closely. I mean, everyone thinks that with the Fed cutting rates, that yields are going to go down and bonds are going to go up, and that's actually turned out to be the exact opposite because the bond prices are, able to price things in ahead of time, and so they were pricing in the rate cut cycle. And so as soon as the Fed actually cut rates in September, like they did on the 18th, what'd the market do? The bond market actually dropped. So the bond market went down. The yields actually have gone up. Look at these recent pushes to the upside. Let me go back to like a daily chart. So if I go to the daily chart here, look at the 2-year. We went from 3.5 back to 3.9, another 0.4% higher, which may not seem like a lot to anybody out there, but if anyone wants to buy a house right now and you're seeing an interest rate go up by 0.4%, that affects your bottom line. Like that makes a big difference to your house. So the 2 and the 10, which have been disinverted, are starting to actually steepen again. And so I do wonder if the labor market improves that we get it back into this inverted yield curve and we see what that looks like, in the next 3 to 6 months. The mortgage rates have actually gone up from 6.08 up to 6.12. I do think the Fed is going to cut another at least 25 basis points, but they're positioned for maybe another 50 basis points, which means 0.5%. But what's the big question mark for next year is okay, so this is November. This is a pause, and then this is a cut by 25 basis points. So the market's anticipating that the Fed is still going to cut November 7th, 2 days after the election, and cut by 0.25%. And if they cut in November, they're likely going to cut in December as well. So if we get another cut here, another cut here, the big question mark is, are there additional cuts coming in 2025? And right now, it's not as aggressive as it once was. The Fed is only predicted to have about 0.9% of cuts, roughly 1% of cuts, versus like 1.5, 1.6. So we're not going to see as dovish of a Fed going into 2025.
So let's look at like the election.
Yep.
First of all, last week, was there any impact with
the vice president debate?
Yeah, nothing.
Yeah, zero impact.
And so now we have this whole thing going on with the docks and, ports being closed.
That's resolved.
I thought that was on pause until January.
It's on pause, but basically to not hold the American economy hostage right now, they're like, look, we'll come back and circle back to this in January. They settled on like a 60+% raise. It was like 62% raise. They put a pin in it for January, so they're going to revisit it. I mean, so the good thing is it was resolved. It doesn't have to be this thing that's going to weigh on the economy and weigh on inflation. And if there's scarcity, all of a sudden crap gets more expensive. Like, yeah, that's a terrible situation. But it also shows that we as a country are terrible at manufacturing and we're way better at importing. So when you have strikes on our imports, right? I mean, when things are coming in, it's like we don't have longshoremen or dock workers to actually do their job. And again, like, I need to do more research on it, but it's like when I hear and read the headlines of, some of these workers are making $250,000 a year and they're not happy with a 50% raise. I mean, that's the power of the union. But I mean, Brandon, in 10 years, man, I'm sorry to say it, but a lot of those workers won't have jobs because it's going to be automated.
AI and robots actually in the field doing the work.
Yeah. So I think that's the sad part is like, I don't know what their motive is other than if we're going to take a leap of faith and like try to get our earnings and revenue and fight automation, now's the time to do it because they're going to be replaced at some point. So if they can get ahead and, pad their earnings for the next 2, 3, 5 years before things are fully automated. And it's very few that have the jobs, good for them, but it sucks, but it's going to be the reality in a lot of industries. I mean, unfortunately, if you're in transit, transportation, anything in manufacturing, anything on assembly lines, I mean, I'm sorry to say it, but automation is going to be what happens. And there's going to be a lot of displaced workers out there in the U.S. And that's going to be globally too. But I mean, the U.S. where we're so bottom line oriented and we're so corporate profits over all things. Unfortunately, we're going to have a lot of workers that are lacking the skill sets to really perform at a high level. So, there's ways to educate yourself, but there's also, I mean, this is why I like what I do as far as investing, because this is kind of recession proof. If the market takes a crap, I'm trading it, and I can hopefully work my portfolio in a way that I can benefit, make money during a downturn or make money in an upturn and, stay invested and be pretty active to make sure I'm managing my own, my own finances. So, right, and that's where I'm able to, participate and help a lot of people.
So final thought on your journey. If you were to invest in a stock this week, what would that stock be?
Actually, one that I just started to take some interest in is Boeing. And the reason why I started to take interest in it is because, this works two ways. One is, I believe this is a bit of a value play. I mean, Boeing is essentially the only aircraft maker in the world that's big and has a long time history. They had a lot of bad press this year because there was I mean, a door flies off in the middle of a flight. Like, I get it doesn't look good, but who else is stepping in saying, well, we're gonna make all the aircrafts now? Nobody. Like, Boeing makes the aircrafts, and so as long as they don't have any major screw ups here in the next 3, 5, 10 years, I mean, the price from the all-time highs here, Brandon, is the stock is down about 65%. Now, I'm going back to anything I can get my hands on. If I see something revisiting COVID lows, I'm pretty interested in taking some stabs, at least some type of position. And Boeing is one of them. So I actually started buying around 152. And I have another position at 120 and another position at 101. So I'm essentially going to dollar cost average into Boeing now and here and look to see, even if we just get back to a range around 250 or so, my cost basis, let's say I get filled on one position. Well, from 152 to 2, I mean, let's say I make $100 a share. It's pretty good money,
Yeah.
right? So it's something for me that I can set. I don't have to worry about. I can set 3 levels of dollar cost averaging. I'll have enough options here, or I'll have enough of a stake in the company position wise to actually control options, and then generate some income, lower my cost base a little bit. So my goal would be, if I establish a base right here of where I own the shares, if I can chip away at my costs with selling some options or generating some income, I can lower my cost basis to maybe 130, 125, and then when we get back to 250, rather than just owning it at 150, I own it at 125, and so I can increase my dollar per share all the more. So Boeing is one company that I do like, and it's also in the defensive space. If we go to war, let's say this Israel, Hezbollah, Middle East stuff escalates, let's say China, Taiwan, let's say whatever. If we start producing aircrafts for war, Boeing's going to be a part of that too. Now, the defensive stocks like Lockheed Martin and some other aerospace stocks have actually done really, really well. Boeing is one that's, I think, undervalued as opposed to being at all-time highs. I think Boeing has a chance to actually show some value there. So
I think
that's why I like it. That's why I like it.
that's great, and you can get fractional ownership just by buying it off a cash out.
Yep,
So
you can trade. I mean, a lot of stocks now depends on your broker, but when you can buy fractional shares, yeah, that's awesome.
yeah,
You can do basically a dollar allocation and say, well, I only have $500 to allocate towards Boeing, so I'll buy 3.5 shares or something like that.
yeah,
Yep.
no, I love it. Great job. Let's start, watching this, and we'll put Boeing on the list, and let's see how we do.
Cool.
I'm all in. All right, Chris. So great job, great week. Let's do it again. I'll
Sounds
see
good, man.
you next week.
All right. Thanks, Brandon.
All right, guys. Listen, the goal of this is just to share the journey and to learn. At the end of the day, we can talk about all the macro stuff that's going on in the world, but how do you make money now? And so we listen to our team and just the journey that they're taking, and then it gives us a peek into some experts' eyes, and we take that information and then we do with it what we will. And so the goal is, again, mindset, replace our 9 to 5, active and passive investing, and then finally, of course, our retirement. And so we take that journey through several ways. We talked about that earlier. You can reach out to us for more information about what we're doing, and we would love to share it with you. And if it works for you, it works for you. All right. So have a great week, and we'll see you next week. Bye-bye.